Well, you asked about three. Let me unpack a couple of them. First of all, last time we spoke was in October 2025. We broke it through 50, and then, as we all know, went to like 120 in January. But you asked me what's happened since then. So I think one of the main questions is silver, has the bottom been reached? And the market appears to have established an important floor near the $50 level, but I wouldn't declare the correction completely done yet. My working range remains between the low 50s all the way up to 90, and until the market demonstrates that it can hold above the upper end, which would be above 90, we haven't really reestablished the bull market per se. The recent recovery in the mid 60s is very constructive, but silver needs to remain in that range and higher, not merely a short covering rally, which is taken into that level currently. So I'm more concerned about how many weeks of activity we stay above, say, 60 than any other technical indicators. So I think you could state that silver is a very small market with a very large monetary story attached to it, and that guarantees further volatility. It's the swings at the monetary demand that moves the silver price up and down. The industrial demand is key. It's over 60% of the market, but it's pretty steady Eddie, meaning in a bad year, it's off 1% or 1.5%, which 1% of a, $60 billion market is still a big number, but 1% is only 1%. So as the $100 blow off top, that's another question. And I would distinguish between a cyclical peak and the completion of a larger bull market. I don't think it is the peak. Undoubtedly, silver became overheated and ran too far too quickly. But I want to remind everyone, Charlotte, that the last time we interviewed in October last year, silver is up 70% as we speak. Or no, it wouldn't be a 50. Sorry, it's up substantially from the last time we spoke, and I think that's key because a lot of people look at it as having missed the top, and if you didn't get out above 90, you missed that top. But I think the leverage momentum trading and speculative enthusiasm was amplified, and that caused the advance. And this correction removes that excess speculation, but it didn't eliminate the underlying monetary and industrial case. So those are still intact. The true secular top would normally include a much broader public participation, persistent shortages, and widespread media excitement and speculative excess into the mining shares. We didn't see that. The last one I would add is usually when you get a top in the metals, you're getting, I wouldn't say necessarily a bottom in the stock market, but you're getting an inverse in the stock market. In other words, people that were in love with the stock market for the last 20 plus years start to sell off, get out, exit, take profits, buy puts. In other words, gold and silver, especially gold, are most negatively correlated to the stock market in the long term. There's times when they trend together, but not for long. So the move to 100 is probably a speculative peak, not the ultimate.
Rather than obsessing over single-day price swings, seasoned traders are watching something more telling: how long silver can hold above $60 before the next real test arrives. As of mid-August 2026, silver trades near $65 to $67, with the gold to silver ratio sitting around 67 to 1, close to its long-run historical average near 60. Until silver can sustain a move meaningfully above $90, the broader trading range between the low 50s and roughly $90 remains intact. A recovery into the mid-60s counts as constructive, but constructive isn't the same thing as confirmed, and that distinction matters more than any single headline.
But I anticipated the move to 100. First of all, I did what I said I would do. I told all of my members that I would throw a party when, I didn't say if, when silver hits $100 an ounce. The problem with that commitment, Charlotte, is that I had to get the venue, put down the deposit, coordinate where, when, all that, a couple months in advance. And silver had not hit the $100 level yet. Yet I still had to send in the funds and make the arrangements and all that stuff, which I did. And of course, then it begs the question, well, if we didn't hit 100, David, what would you do? And the answer would be, I would stand up and take it like a man and say, look, we got to 85 and we got 85% there. And the reason why, is as follows, but it did. So there's that. But I had, to your question directly, anticipated this blow off move. I put a PDF file together for my paid members, and I urged them to take partial profits on the way up, selling into strength. And many did. And many that did came to the party. And some showed me what they'd done with the proceeds or told me what they were going to do with the proceeds or whatever. And it was very exciting for everybody. But I suggested starting to take profits at the $80 level. And I'd have to look at my own PDF. It was 80, 90, 100, or 80, 100, 120. But it was spaced out, like, sell 20% when it hits this level. It goes higher, sell more. If it goes higher, sell more. And some sold it all. I mean, it was guidelines. It's not, it has to be 20%, but at least take something off the table. So that's how I approached it. I also approached it on the gold-silver ratio because many of my clients are, not my age, but they're 50 or older. Some are younger. I've got them all over the map, but the majority are probably mid-40s or older. And they want to swap silver to gold at the proper ratio. So I also did a PDF file on that and published it at the same time for my members. I said at 50 to 1, swap some, not all, but take partial, moves from silver into gold. And it did hit that. And that's the best it did, is in that range. The idea was the same, 20% swap at 50, 20% at 40, 20% at 30. And if you really want all gold, if it gets below 30, swap the rest out, kind of thing. So thanks for asking. I just got a nice letter. I can't find it. But basically the gentleman said, thank you for, providing this information to me. I did well. I'm financially independent now. Your guidance was invaluable. I don't want to embellish it, but it always makes you feel good because, as we get beat up, especially when, you make a bad call and, sometimes I made a bad call, but I've adjusted it for my readers, but people that hear you and only know me from your channel. I mean, there's people who don't know I have my own channel or whatever. And well, David said blah, 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 blah to Charlotte. And it's true. I can't take it back. But they don't know that I changed my opinion or data showed otherwise later on and I made good on it. Not that I'm perfect. Not that I haven't made errors. But, unless you follow my work, let's say, from, not say daily, but as I publish, let's say, you don't really know what I'm doing. You can criticize me for things gone by, and that's okay. But until you're running the race with me, you really don't know what I'm doing. I hope I don't sound like I'm trying to be defensive, but, I do my best, and it isn't perfect, but I'm not far off the mark most of the time.
One lesson from silver's run to $120 had less to do with prediction and more to do with preparation. Analysts who publish scaled selling guidance, taking partial profits at defined levels on the way up instead of trying to nail an exact top, found their followers far better positioned when the reversal actually hit. A related strategy uses the gold-silver ratio itself as a signal. As the ratio compresses toward historically low levels, gradually swap a portion of silver holdings into gold to lock in relative outperformance. Neither approach guarantees perfection, but both replace guesswork with something repeatable.
That's a good one. What was holding gold back in the first of the year? I think normal cycles. And normal cycles means, as I've already explained, way too much enthusiasm. I mean, markets go from undervalued to fair value to overvalued. And even though I think gold and silver are undervalued, and probably were undervalued at their peak, doesn't mean they weren't overbought. There's a difference between being undervalued or overbought. And the futures markets control the price of gold and silver, as we all know. And those are speculative casinos most of the time, especially in a frothy market. So I want to make that distinction. I think that's very clear. But gold was held back primarily due to that advance. The other principal headwinds were higher bond yields. That aggravated the energy in the sector, and of course the war started in, I guess, late February. A stronger dollar does affect the precious metals. Weaker ETF demand, it blew off that top, and then some withdrew and took their profits and left. Profit taking on a technical basis. Reduced expectations for rapid Fed easing also added to it. And it's a competition from stocks and cash. When the stock market continues to make new highs and people already in the stock market maybe haven't allocated to the metals at all, or have a minimum allocation and watch it go up and down, they get scared out. They don't want to reallocate or rebalance. So I would say those are about the four main reasons. Well, as I said earlier, I do think we could go back down once again. In fact, it wouldn't surprise me to see what I call spike low. Like, it's like a parabola going upside down. It's obviously it's a big drop. It could be called a waterfall decline. I like to call it spike down. But so I think we could see this $60 level, 65 where we're at today as we're doing the interview, and move along there for weeks. And then all of a sudden something comes out of the news or an event at a depository or something that moves the market rapidly down for a matter of hours, a day or two, doubtful a week. The spikes are called spikes for a reason. They're very quick, very sharp, substantial, scary, especially if you're on leverage, but they don't last long. So I don't rule that out. The current events, cooling inflation and weaker employment. The July CPI showed 3.4%, while core inflation declined to 2.5%. This, combined with recent weak employment reports, has reduced expectations for another imminent Federal Reserve rate increase. The Strait of Hormuz and Iran, of course, are key. Escalation creates safe haven demand for gold. Higher oil prices create additional inflation, and additional inflation can keep interest rates elevated. So elevated rates and a stronger dollar tend to restrain the gold market. Silver can initially benefit as a precious metal, but suffer if expensive energy threatens industrial activity. So you got those two negatives based on what's happening in the Strait of Hormuz and this war with Iran. Oil approaching $90, which we've seen. Monetary inflation and reason to buy gold are for that, but a reason for the Fed to maintain higher rates are because of that pressure. So again, there's kind of both sides of the coin. And renewed Western ETF buying. Global ETFs attract approximately $3 billion in July, reversing 2 months of outflows. Holdings increased by 23 tons to 4,000 plus tons. Europe led the buying, while North America participation was rather modest, according to the World Gold Council. So central banks have supported the gold market for years, as we know, and the next major leg may require Western institutional investors to return, and they have not.
Several forces converge to pull gold and silver back from their highs. Rising bond yields increase the opportunity cost of holding non-yielding metals. War breaking out in the Middle East in late February 2026 initially boosted safe haven demand, but it also strengthened the dollar and pushed oil toward $90 a barrel, a headwind for industrial silver demand even as it supported gold. Meanwhile, cooling expectations for rapid Fed rate cuts, fading ETF inflows after the speculative peak, and stiff competition from a still rallying stock market all pulled capital away from the sector. It's a reminder that precious metals rarely move for just one reason.
I bought silver at 30 plus at one time, and thinking at 30 it held for almost a year or a little more. And I thought, okay, I'm safe adding on the way up. And then I was wrong, and I made the call that I was wrong and said it was going lower. So excuse me as I digress. I did this very similar thing, and I learned it from Jim Dines. And I think, I know you're old enough to remember Jim. You were quite young, but so Jim did buying zones, and I thought that was smart because, this is the bottom. No, it's bottoming here. I'm safe. So I put out for my readers that buying silver under 60 was the beginning of the buying zone. Buying gold under 4,000 was the beginning of the buying zone. And as you know, both metals hit those levels, but not for very long. I added to my silver at below 60. It might have been a touch above us, right in that range. And then I added to my platinum position, which I don't encourage everyone to. There's a big spread on platinum, just like there are gold and silver at the retail market right now. But I had a good base at around 1,000. And once it got to the 1,600-ish level, I said, that's close enough. I think that's fair. And I bought around the $1,600 level. And today, I think we're like $1,750 already. Not that every trade I make, and I wouldn't call this a trade. This is to my core position, but a buying zone and a selling zone. And that's what I was doing on the way up. Here's a selling zone. Don't expect to get the top tick. I mean, that's an amateur's game. And I used to play it. I mean, I started investing in stocks at 16. And I thought, well, I'll buy it here, the exact low that one day hit that price, and I'll sell it here, the exact price it hit for 2 hours during the day. It doesn't work that way.